If the Magnificent Seven no longer leads the AI boom, where should investors look next? And how can portfolios adapt before the market does? Today's video breaks down the shift from the old guard to a new AI elite, what's driving it, and how global investors can ride the infrastructure wave without chasing hype. Quick credentials so new viewers know the lens here. The Investing Iguana is ranked 8th in the 2024 Influential Tigers by Tiger Brokers. We just crossed 1 million reads and 58,000 likes. Over 1,000 videos produced with more than 600,000 watch hours as of August 2025. The focus here is US, regional, and global economic trends. This episode is adapted from my latest in-depth Substack deep dive. Link in the description. Here's the roadmap. First, why the Magnificent Seven framework is breaking down. Second, who's rising and why. Third, what the article's tables reveal in plain English. Fourth, valuations and risk. Fifth, the infrastructure thesis that ties it all together. Finally, a personal take and actionable steps for both US and international investors. Picture two investors in 2023. Both bought a Magnificent Seven basket and held. Fast forward to mid-2025. One feels great about Nvidia, Microsoft, Meta, and Alphabet. The other is staring at Apple and Tesla and wondering what changed. That divergence isn't a blip, it's the pivot point. The old label explained yesterday's winners. It doesn't map tomorrow's AI cash flows. The article frames it clearly. The S and P's gains were concentrated, but AI returns are now spreading into firms built around AI demand itself. That's the investor problem. If the label drove allocation, the label may now misallocate capital. Think of two columns in the mind: company size and this year's performance. The traditional giants, Apple near the 3.4 trillion mark, Microsoft around 3.1 trillion, Nvidia about 3.2 trillion, Alphabet roughly 2 trillion, Amazon around 1.9 trillion, Meta about 1.3 trillion, and Tesla about 800 billion. Now, the scorecard: Microsoft up mid-20s, Nvidia still strong year to date after a huge prior run. Meta and Alphabet up in the 20s to low 30s, Amazon up single digits, Apple down a bit, Tesla lagging. On the challenger side, Oracle's had a huge AI-fueled surge. Broadcom has been propelled by custom silicon demand. Palantir's growth in AI software has been a standout. And Taiwan Semiconductor, the quiet kingmaker, keeps scaling with advanced nodes. The takeaway: leadership is fragmenting and reforming around where AI capacity is actually built and deployed, not just announced. Quick pulse check. Does the portfolio still mirror a 2023 story, or has it evolved with where AI dollars are flowing in 2025? By the way, for the full charts, checklists, and the written playbook, grab the Substack post. Link in the description. Screenshots in the post are great reference points as you review holdings. Let's tell this as a road trip through the AI stack. First stop, Oracle. A few years ago, many saw legacy software. Today, it's a cloud infrastructure pit stop for AI training runs, with a swelling backlog and marquee workloads. That's not a pivot for headlines, that's a pivot with contracts. Second stop, Palantir. Instead of move fast and break things, the company has been compounding adoption inside government and critical industries where breaking things isn't an option. Its platforms, Foundry, Gotham, and its AI layer sell not the buzzword, but the result: faster, safer decisions at scale. Third stop, Broadcom. While Nvidia sells the general-purpose engine, Broadcom designs custom silicon that fits the exact chassis of the largest platforms. When every watt and nanosecond matter, bespoke wins. Fourth stop, Taiwan Semiconductor. The factory of the future, today. Without advanced nodes, there is no cutting-edge AI training or inference. That means AI demand translates into Foundry revenue, even when app-level winners rotate. Oracle's cloud growth is being pulled by AI workloads. Palantir's commercial growth in the US is accelerating alongside platform stickiness. Broadcom's AI revenue line has exploded thanks to custom chips for hyperscalers. Taiwan Semiconductor's revenue mix is dominated by advanced nodes tied to AI and high-performance computing. In other words, these are not passengers, they are the road. If the strategy so far was own the platforms, the update is own the platforms and the picks and shovels that the platforms can't live without. Labels evolve when markets do. The article walked through new groupings: a Fab 4 built around Nvidia, Microsoft, Meta, and Amazon, a Big 6 that quietly drops Tesla, an Elite 8 that adds Broadcom to the old 7, and a Magnificent 10 that folds in Broadcom, Palantir, and AMD. Each grouping tries to solve a gap. Trim to focus? That's the Fab 4. Keep the scale but drop the misfit? That's the Big 6. Acknowledge custom silicon's rise? That's Elite 8. Recognize software plus silicon breadth? That's the Magnificent 10. The bigger point? None of these is gospel. They are lenses. Some portfolios need a narrower lens for quality and margins. Others need a wider lens to capture infrastructure and software together. If a name falls out of a label, is that a sell signal or a chance to revisit the thesis with fresh numbers? This is where good stories go to die or prove they deserve their multiple. The article called out the spread in valuations. Some AI specialists trade at premiums that leave no room for a stumble. That doesn't make them bad companies. It makes them fragile tickers. The lesson is simple. Separate AI adoption from AI economics. Is revenue ramping where it matters? Are margins expanding with scale? Are contracts sticky, multi-year, and with power buyers? If yes, high multiples can compress without breaking the thesis. If no, high multiples can compress and break the thesis. This is where risk budgeting matters. Let earnings leadership pull position sizes higher over time. Let hype shrink by default. Ask this before buying. If growth slows by a third, does the stock still make sense on a 1 to 3 year view? The article's backbone is the idea that AI is not just software magic. It's industrial policy meets data center physics. Chips must be manufactured. Power must be delivered. Memory and storage must scale. Networks must rewire. Clouds must specialize. The winners over the next leg likely include firms that benefit regardless of which app wins, foundries with the leading nodes, custom chip designers in hyperscale, cloud operators selling AI-native infrastructure, and networking, memory, and storage providers tied to capacity growth. That's why companies like Taiwan Semiconductor, Broadcom, Oracle, and yes, select memory and networking players feature so prominently. When the pie grows, they get a slice by default. Market cap is gravity. Price action is weather. Infrastructure names have lower narrative risk because the demand comes from the build-out itself. Even when app-level darlings rotate, the backbone keeps billing. For international investors, this is critical. Currency moves, withholding tax, and local access matter, but the underlying cash flows link to US-led capex cycles that remain robust. If the goal is compounding, consider anchoring part of the equity sleeve in must-have infrastructure and layering selective software exposure on top. Here's the personal lesson learned across cycles. Labels help us begin. They mislead us if we cling to them. FANG once mapped a moment, then it didn't. The Magnificent 7 captured a phase. Then AI changed the gravity wells. In this phase, the clearest path for most investors is to pursue what can't be easily disrupted by a single feature release: capacity, fabrication, custom silicon, and AI-native cloud. That doesn't mean avoiding application software. It means letting application exposure earn its way in through evidence, contract growth, margins that improve with scale, and customer concentration that shifts from pilot to platform. 3 decisions shape this approach. First, treat the new groupings as menus, not mandates. Pick the businesses, not the acronym. Second, manage the multiple. When quality meets hype, size the position for volatility. Third, keep a macro eye on power, rates, and capex. AI build-outs ride electricity and cost of capital. If rates ease while power investment accelerates, infrastructure beneficiaries may surprise to the upside. For US-based investors, tax-advantaged accounts can house higher volatility AI software, so drawdowns don't trigger behavioral errors. For international investors, ADR liquidity, custody fees, and withholding tax matter, so infrastructure names with deep liquidity and options markets can make risk management easier. The challenge is simple and useful. Can any position defend its cash flows if the market stops cheering for 6 months? We started with the question: if the Magnificent 7 is yesterday's map, what's today's? The answer is a broader, more grounded AI elite. platforms that print cash from AI usage, and infrastructure names that get paid when the build-out grows. We translated the article's tables into a spoken guide, walked the new groupings, pressure-tested valuations, and made the case for the infrastructure imperative. If this helped, like the video, share it with an investing friend, and subscribe for weekly deep dives on the US market with a global lens. For the full charts, checklists, and the written playbook, grab the Substack post, link in the description. And if long-form strategy breakdowns are useful, consider joining the membership for model portfolios, quarterly playbooks, and live Q&A. One last thought to leave on. Will the next acronym capture your portfolio? Or will your portfolio capture the next decade's cash flows? Suggested related video is AI Data Centers Explained: Power, Chips, and the Quiet Winners.